But I believe, as a sort of a rule of thumb in systematic savings, that 10% is probably an adequate allocation to gold.
Hi, my name is Ken Lewis, CEO of APMEX Inc. And here today with me is Rick Rule from Sprott.
Thank you.
Thanks, Rick. Well, today we're going to talk a little bit about precious metals ownership and how it should fit within your portfolio. So if you were a young man, 22 years old, 25 years old, and you were looking to start your investments and you had $100 to put away a week, how do you think an individual should go about gold in terms of ratios or views, or is that just too generic of a question?
No, I don't think it's too generic. I think partially it depends on the subject's means and how much risk he or she is willing to take.
Right.
But I believe, as a sort of a rule of thumb in systematic savings, that 10% is probably an adequate allocation to gold. There are some people who are more aggressive and hence need to own less gold. From my own point of view, it's interesting. I don't want anybody to conflate me with a 20-year-old, which is probably not going to happen. But the truth is, when you think about the fact that I'm, as an example, the largest shareholder of Sprott, my life is wrapped around gold, but I still own a lot of gold. And I own gold because I like to be liquid. I know that during tough times, if I have liquidity, that I can take advantage of the situation rather than being taken advantage of. Gold and cash helps me sleep nights and stay calm. And I suspect that a 20-year-old today, assuming that that 20-year-old lives to be, let's say 80 or 90, he or she will experience 6 or 7 or 8 liquidity crises, market declines in his or her career. If you have liquidity, particularly if you have good liquidity, physical precious metals, you take advantage of the situation rather than being taken advantage of.
Right. Good points. Yeah, no, one of the things that I focused on more recently is thinking more about wealth preservation rather than necessarily wealth gaining or growing the wealth. And you think differently sometimes, a little bit about that. And I think some of the aspects of how you would invest in metals is a good example of that. Maybe how much cash you're willing to have, maybe how much real estate you want to hold in terms of your portfolio. You start to move your assets around to be, in many views, more conservative in some natures, just because you're trying to preserve wealth and not see that it, in a down market, could disappear so dramatically.
You make a good point. One of the interesting things about gold is the price volatility in gold actually makes it a fairly efficient form of insurance. If you look at the decade 2000 to 2010, at the beginning of the decade, confidence in the economy was extraordinarily high, and gold sold for $250 an ounce. Someone who would have put, say, 10% of their net worth in gold would have seen 6-fold appreciation over the course of the decade. The equity markets did well, but let's assume for a second that the equity markets didn't do well. Let's assume that that decade looked like the decade, of the 1970s, where common stocks fell by 25%. The truth is that a small holding in gold, 10% of one's portfolio, would have more than hedged out all of the losses that they expose themselves to in other parts of their portfolio. That's really the beauty of gold. When times get tough, a little bit of gold goes a very, very, very long way. That isn't to say that people who have an opinion about price need to use it just as insurance, because certainly 6-fold appreciation made it a very good investment asset too.
Okay, Rick. Man, time's flown by. I'm getting close to retirement, and naturally, I'm looking at my investments. I'm looking at my assets, and I want to make sure I'm doing the right thing, not only for myself but for my family long term. And I want to kind of get your thoughts on how you look at that from your perspective.
Again, Ken, it depends on the retiree. What we find as people age and as their investments become allegedly more conservative, they become much more interest rate sensitive, which means they tend to go to deposit products and they tend to go to bonds. And those are precisely the assets that will do very well for you until they don't. And during the points in time when they don't, gold again forms a wonderful insurance function. A pure financial planner would probably say that you need less insurance as you age because you're wealthier and the time that you're trying to defend your purchasing power for decreases. But the truth is that people's psychological need for security increases as they age. And the truth is, and this is personal again, I'm not speaking as Sprott, I'm speaking as Rick Rule. The essence of wealth, Ken, is enhancing your sense of well-being. So when you're talking about an aged person close to retirement, you're looking at one. And the truth is, as I say, physical precious metals and cash, liquidity, help me sleep nights and stay calm, which is important to me.
Yeah, that's a good point. You know, one of the things I've been thinking a lot about is where precious metals fits in the fold, right? And you can go out and look at it from a diversification standpoint. You can go out and look at it from interest rates and are they attractive for investments today. You can go out and look at it from concerns about the dollar being printed at all-time high rates. But at the end of the day, it seems like any way you look at it, it seems positive in having some exposure to precious metals in your portfolio any way you slice it.
Well, I think that's accurate, irrespective of your outlook. But I think particularly in the context of people examining the way they feel today relative, if they're older, to the way they felt in the decade of the 70s, or the way they felt in the tech wreck of 2000, or if they're old enough, how they felt in 2007. During periods of time of instability, during periods of time when your confidence gets challenged, gold traditionally has done very, very well.
Yeah, we were looking at 2007 and 2008 recently and looking what the equities markets did on the pullback and just how well precious metals performed.
Yeah.
And it just reminds you that it acts as a hedge, a natural hedge to equities.
It's important to note that in a very sharp, liquidity-driven decline like 2008, gold sells off too.
Yeah.
Because the liquidation decision isn't made by the investor, it's made by the margin clerk. But it also comes back more quickly. People who were prudent, who went into the circumstance with liquidity, who are looking to park surplus cash into an asset that will sustain and support their purchasing power. During periods of trust, people go into gold. Remember, and I know you remember because you sell it every day, gold is a medium of exchange and a store of value simultaneously. A dollar is a promise to pay. Gold is in fact payment. You don't have to trust anybody because it is payment. It's not a promise to pay. And in the aftermath of liquidity-driven circumstances, demand for gold is very high for just that reason. You don't have to trust anybody.
And do you have any views that the scarcity of gold, that the amount of mining being done in today's world and the availability of gold, when we think about as demand starts to resume itself for gold at levels like we've seen in previous days, what's your view on what that does to the price of gold?
Well, I'm a believer that markets work. I'm a believer that price will take care of scarcity. It might take care of scarcity at a very, very, very different level. If you think about a circumstance, going back to the earlier question, where gold would go from 0.5% of the savings matrix in the United States to 2%, in other words, where you would quadruple demand for gold. The gold will be there. Remember that almost all the gold that's ever been mined is still physical gold. So the gold will be there, but the price might be different. The price denominated in dollars.
Right. Well, it seems like there's a lot of upside on the price is where I was going. Obviously, if demand were to pick up to levels like we've seen in the past, with the amount of individuals out there with dollars to invest, it seems like it's a great opportunity for price appreciation in the gold space over the long term.
That's what I think investors need to wrap their heads around. Investors need to wrap their heads around how small an asset class it is and how it has been efficacious, hate to use those big words, but efficacious over time as a savings and investment product. And it doesn't mean that you have to return to a gold standard. It doesn't mean that we have to go into the Greater Depression. It doesn't mean that we have to have a Holocaust. The only thing that has to happen is that people have to be a little less confident than they are today. Explaining how that would occur would be defaulting to the arithmetic and away from the narrative. And you've answered that question. And gold could do very well. At the very least, it could protect your family's purchasing power, which is what it's designed to do.
You know, one of the things we talked about at lunch today was the upside versus the downside risk of something like gold. You know, you look at where pricing is today, you look at where it is historically, you look at where, you know, only a certain amount of gold is coming out of the ground at any given year and where mining is on that stage. It seems to me like gold has a far lower downside and a much greater upside. Any views on that?
Ken, you're going to hate this answer. Pray for a downside. I mean, a downside means that no insurable event occurred.
Yeah.
Wouldn't it be great if your kids had life insurance on you and they never got paid?
Great point.
Which meant that your great-great-great-grandchildren could enjoy your company. Think of automobile insurance that you never collected on, which meant you never had a wreck. Think of insurance on your house that you never collected on, you never had a fire. I own a lot of gold. And I hope the stuff goes to $400 or $500 an ounce. What it means is that everything else in my life turned out fine. Yeah. By the way, I don't think that's going to happen. Yeah. But when you talk about the upside in gold, I always tell my clients, be very cautious what you think about. That set of circumstances that could cause gold to go to $5,000 an ounce or $12,000 an ounce, while they're certainly identifiable circumstances, they're uniformly unpleasant.
Well, I think your point is well taken. You know, as an insurance policy, gold does its job, right? So if the markets are killing it, and we're all making great money in the equities markets, and real estate's booming, and interest rates stay low, and everything's going hunky-dory, then naturally we're going to be feeling pretty good about our situation. But the reality is, having insurance for the case or situation where that doesn't occur is a smart play for any investor.
My belief, everybody needs to default to a different downside. That is the downside associated with $120 trillion of debt at the federal level. People avoid it because people don't want to think about bad things. People say, like smarter people than me don't care about this because the S&P goes up. It does. It goes up until it doesn't go up.
Right.
You know, our last president said the debt didn't matter because we owe it to each other. Well, that's wrong. The spenders owe it to the savers.
Yeah.
In a democracy, of course, the spenders are more numerous than the savers, and so the spenders always vote to penalize the savers. There's this great libertarian saying that says an election is where 4 coyotes and a lamb vote on the lunch menu. And the savers, who are the lambs, are precisely the people who need to own gold, as, if you will, coyote insurance.
Fantastic. Great point. Well, Rick, thanks for coming in today. We do appreciate your time and all your insights.
Thank you for the conversation, and thank you for the wonderful tour of your facilities.